Alright guys, welcome back to another video. In this video we'll talk about how to use the 50 daily moving average to get better entries in uptrending stocks. So I will just type it out. First of all, the moving average um, can be simple or exponential. It doesn't really make a lot of difference, and you will understand why in just a few minutes. All right. So let's start with the theory. What the theory is. So let's take any moving average. Let's talk about how a moving average actually works. So if uh, if you have a 50 period moving average, right? It basically means that you will take the average price of the last 50 days, and then as the 51st day happens, you will exclude one from the end, and you will add this to the average price. So that's how a moving average basically works. So now what is happening here is, let's say price is range bound. Let's say price is fairly range bound for 50 days. So the 50 moving average of the closing prices of all the days will be somewhere in around this, inside this range itself. All right, because price is consistently it's range bound inside these days. So what is happening here is, all the 50 days are inside the range, so 50 moving average will also be here. Now let's take an example where price breaks out suddenly. All right, so price is basically trying to break out on the upside here. All right, this is what happens after the 50-day range. A range can be obviously 45 days, 30 days, any kind of range can be there. I'm just taking an example here. So price breaks out here. All right, price breaks out. Now the closing price of these 2 days are here and here. All right, so this price and this price is the closing price of these 2 days. So now what happens? The moving average will start to go up, but will it go up like this? Absolutely not, because it is not a moving average of 2 days, right? It is a moving average of the rest of the 48 days as well. So 48 days here and 2 days here, right? So these 2 days won't influence this average a lot. So moving average will go up, but it will go up slowly. All right. So what is the pattern here? Whenever price starts to break out, you will see that it is moving away from the moving average. All right, it is moving away from the moving average. All right, so now after the breakout, when the breakout is has already happened, if price goes range bound for 50 days again, then the moving average will catch up. All right, so when the price is moving in a direction, in a unidirectional movement in one direction, you will see that moving average is doing the catching up and price is moving away. All right, so how can we use this information when we are using the 50 daily moving average? First of all, why 50? Because 50 days basically includes 2 months of trading activity. Each month has around 22 days, so around 45 to 50 days you will get 2 months of trading activity. So it's a fairly good time for a range to develop. All right, so for a range to develop, so 50 daily moving average works best for me. Again, using 45 or 55 won't really make a lot of difference, because we are not using the moving average as a hard line. All right, we are using the moving average to see how far the price has already moved. So let's take an example here. Let's look at this area on the chart. All of these areas on the chart. So let's take this area. This is a breakout. All right, this is a breakout. Now, if you're looking for a continuation move here, let's say something like this. So you have to see that it's very far from your moving average. All right, it's very far from your moving average. It means that it is very far from the previous base of price action, right? So this means that price, the first base is done, and price can, just a second, my bad. So price can pull back to the 50 daily moving average again. All right, it is too far extended. So when the price is already far from the moving average, we can conclude that that some sort of move has already happened. And you will say that obviously it's very visible in this scenario that some move has already happened. So we are extended from the previous base. It's quite clear here. But what is the use? What is the use of EMA if we can already see big candles? So let's see another example, which is very important here in this area right here, in this range, inside the range, right? So inside the range, if you see from the low, this is the low which is made. From the low, price goes all the way up. All right, price goes all the way up, and this is the pullback which starts to happen. So let's say there is another breakout here. All right. So if you try to buy this breakout, you will see that you are again far from the moving average. All right. So moving average is somewhere here. You are very far from the moving average, right? So when this happens, even inside a range, you will know that some sort of a move has happened before. So even though this pullback looks good and everything looks inside the range, see, this is a very clear breakout, right? This one is a very clear breakout. So you will be able to spot this very clearly without the moving average. But when this is happening inside a range, let's say this area, it will be very difficult for you to take note of this up move which has already happened. All right. So here you might end up buying a breakout here, and then from this supply you will get again sold off. All right. So these extended moves can also happen inside a range. All right. On the contrary, let's look at this range right here. All right. And now look at this move, right? This is your higher low which is being formed. This is formed right at the moving average. All right. And also cleared out this tiny supply here and entered this base as well. So it's starting to turn bullish here. And now if you buy here, your risk is very small. All right. Your risk is just this part. All right. Whereas if you buy the breakout, look at how far you are from the moving average already. Even before entering the trade, you are already so far from your moving average, right? So this will help you avoid extended trades even inside the range where you might think that you are safe. All right. Now a lot of people will talk about these trades, all right, where trades like these. So let's see why we should avoid these trades, even though it looks like they are moving quite well. All right. So this particular scenario is extremely bullish for this industry. All right. This particular time was extremely bullish for the shipbuilding industry. It's still bullish after another base which has been formed, but this is extremely bullish for this industry. It was during this time, during the end of the second half of 2022. All right. So obviously a lot of stocks were going up, but if you try this and these entries in 10 stocks, I can assure you 8 out of 10 are going to fail. All right. So this is a very exceptional period. Don't try these entries. Instead, you look for these bigger bases and look at these entries right here. Very close to the EMA, very close to the previous demand, inside the base as well. All right. So this is an entry which you could have taken. All right. So let's look at a few more examples and how do we actually use it in a stock. Again, if you see here, look at all these entries. These will fail. All right. These contraction entries, they will fail. If there is a contraction, they will fail. But if you look at something near the EMA, this is extremely good. All right. This you just buy here, and you can trade it till the highest supply as well. All right. So you see again something here. These entries are good, but if you try to buy the breakout, this will come back down. All right. Again, you can try and buy here. This might work out. See, this is also worked out here. So staying close to the 50 EMA, if price moves far from the EMA, when price is breaking out, if it's moving far from the EMA, it means that if you're near to the EMA, then there's a chance that price will move away from you. All right. So there's a chance that price is going to move away from you. So if you're already far from the EMA, the higher chance is actually price coming back to the EMA. All right. And that is the main use of the moving average here. All right. We look at one last example. You see all the big moves, all the moves which are coming out of bases, they are starting right from the EMA. All right, see this one as well, right from the EMA. Obviously, sometimes the moves will fail because the market is falling. So you also have to look for other parameters as well before you buy these stocks. All right. So this is it for this video. We'll end it here. And if you learned something, kindly like, share, and also subscribe to the channel as well. All right. I'll see you guys in the next one. Have a good day.